Welcome to TFN Smart Investing's Market Insights. I'm Andrew McCord. Well, the numbers are in and they are official. The Chinese economy expanded by 11.5% in the third quarter of 2007, according to the Statistics Bureau in Beijing. Now, growth of this magnitude causes investors great concern, not about the prospects of Chinese companies and the stocks associated with them, but about the reaction that news like this will trigger in Beijing, which already is concerned about runaway inflation and excess liquidity. For investors, this meant a welcome dip in the Chinese stock market. The CSI 300 fell 4.6% in a single day of trading, and the yen rose to close to 7.4820% versus the dollar for the biggest weekly gain in 5 weeks. The short-term trigger for this move was the expectation, or the media calls it fears, that the Chinese central bank will raise interest rates to siphon excess liquidity out of the runaway bull market in Chinese stocks. The idea is that incrementally higher interest on cash supposedly keeps money from inflating the stock bubble even further and helps control inflation. Now, good luck with that, fellas. Now, my guest this week is J. Christoph Amberger, publisher and editor of Taipan, who can answer some of the questions we may have on what it all means for Chinese stocks. Christoph, thanks for being here. Now, do you think Beijing will actually raise rates again, and what can you do about it as an investor?
Well, Beijing still believes that a market can be controlled by the government playing on the dials. What it will cause, definitely Beijing will raise interest rates again, probably several times within the next 12 months. Each time this raising of interest rates will cause a dip in the Shanghai Stock Exchange and in Shenzhen, which really will do nothing but provide a buying opportunity for the continuing run-up in Chinese stocks. One of the biggest factors behind that ongoing surge in Chinese stocks is going to be the continuing new emission of shares in Chinese state-owned companies. China just announced that over 33 state-owned companies will be IPOing by 2010, which should keep the bubble inflating for at least another 12 to 18 months.
All right, well, there are some high-carat IPOs coming up that are not on China's official laundry list of IPOs. What's in the pipeline?
Well, there's two big ones coming out right this week. The first is Alibaba.com, which will IPO in Hong Kong, and PetroChina, which is a Hong Kong company, or Hong Kong listed company, which will issue A shares in Shanghai. Now, these are going to be some of the biggest IPOs the world has ever seen. And again, the positive aspect, in addition to that, is that these are privately owned companies already, or at least investor-owned companies already in the case of PTR.
Well, what do you make of Hong Kong's recent boom then?
Well, Hong Kong is a beneficiary of the low dollar right now. The currency differential between the Hong Kong dollar and the yuan means that Chinese paying in yuan can buy far more services and goods in Hong Kong than they could just across the border in Shenzhen, for example. So Hong Kong assets, Hong Kong equities are benefiting from low dollar policies, very much like the U.S. economy is benefiting in their export sector from the low dollar exchange rate.
And how long will the boom continue?
Well, for China, I think the boom will continue with interruptions, with these buying opportunities I mentioned, throughout 2008, throughout the Olympic Games in Beijing in 2008, which will terminate in August. I think we have another probably 3 to 5 months after that. So we're really looking at what I believe is going to be a post-Olympia crash sometime in early 2009.
Okay, very interesting. Now, is there any practical advice you can give investors?
Well, there's stay in school, don't do dope, and stay invested in the bull market. You can only make money in a bull market if you're actually invested in the stocks that are experiencing these highs. Of course, you need to keep in mind that these stocks will come crashing down, so you need to be tuned into what is going on. You need to establish stop losses and adjust accordingly to lock in the highest amount of profits that you possibly can. This might be a last big opportunity to make money before the big Chinese contamination hits in 2009. And what I tend to recommend to our readers and subscribers is please sign up for our news feed, where we really keep you in touch with what is going on several times a day.
Okay, Christoph Amberger, sound advice overall. Thanks for coming on the show. Until next time, I'm Andrew McCord for TFN Smart Investing Market Insights.